Okay, good afternoon, ladies and gentlemen. My name is Ian Woodhouse. I'm from Orbium. I think you will have heard from my colleague Alistair earlier this morning on his presentation. So we're a business and technology firm. We're one of the sponsors of this conference, which we highly regard. And I should probably also say that change is also taking place in our industry in the sense that in February we were acquired by Accenture. That reflects the fact that our industry and technology is changing quite fast, and with Accenture we're able to bring a much wider range of the technologies that you heard about that are reshaping the private banking industry. This session is really picks up on Mo's point, are we ready? And it's session 4. It's about the next generation, it's about the millennials and the way forward. And I'm very pleased that we have with us today Ian Dembinski, who's the head of Rathbones Private Office. And what we're going to do is we're going to have a little sort of fireside chat around some of the themes that he's seeing in the industry from Rathbones' point of view. And he's also going to give you a view on the industry trends as well. So welcome, Ian, and thank you.
Thank you very much.
My first question really to you is we heard a lot about the growing importance of financial education for clients and the fact that many clients lack education in some of the products and services that we're offering. So really the first question for you is, can you tell me a bit about the importance of financial education in terms of empowering the client's investment decisions?
Yes, I think in general our industry has been absolutely appalling at educating the client base about the basics of financial planning and also running portfolios. And you see some very considerable wealth coming to Rathbones, and we find that they need the basics explained to them. And that's across a number of segments. So we already run a financial education course for 18 to 25-year-olds, and that's after they've left school. And we find that schools actually don't educate them at all about this, which is amazing, really, given the importance of understanding that. And we teach them about all the basics of the costs that they'll find coming forwards, student loans, pensions, mortgages, how do credit cards work. It's just incredible how little knowledge there is. And in fact, my own son and daughter have gone on it and have appreciated now the sheer costs that lie ahead of them. In fact, just as an anecdote, I asked my son what he thought of the course. He said it was absolutely superb, but he had no idea beforehand how much babies cost, which I think is a really healthy thing for an 18-year-old teenager to figure out early. And then what we discovered, because we launched our diversity program, we have a women's forum network, we did a survey, and a lot of women were feeling that they were underbriefed about wealth. And UBS put out a very good survey recently which suggested that women, when they took over wealth, for example, in the event of divorce or death, 70% of them had a really nasty surprise when they popped the hood because they hadn't been engaged in the process. So we launched a financial awareness course for adults, which happens to have been very popular with women. In fact, I actually run that course with colleagues of mine. And we run it in an informal way over 3 or 4 hours. And just to answer the question that was asked earlier session, this is definitively not, repeat, not a sales opportunity. Right. It is absolutely about education, and we don't have any content about Rathbones in there at all about how great we are at wealth management, because we feel that if you educate people well, they will have confidence in your institution and then come back actually later at some given point.
Yeah. Now, women is an interesting segment. I mean, I don't know whether people are aware, but recent statistics from the US showed that women hold 60% of the wealth, and also they own 30% of privately held enterprises in America. And those privately held enterprises actually are quite significant because they employ something like 8 million Americans. So it's a big job creation exercise. What's the situation like in the UK for women? I think you mentioned, that it was a little bit difficult for women in the UK to get access to finance to grow their entrepreneurial businesses.
Yeah, I mean, this is not about political correctness. 54% of our 47 billion of assets are run by women, so it's an incredibly important part of our client segment. And what we see increasingly in the UK is that some 65% of all startups under the age of 35 are driven by women. Very often women don't necessarily want to spend 30 years moving their way up a large organization to get to seniority. They are naturally entrepreneurs, and they naturally want to have flexibility in the way they run their lives. So women are firstly great creators of wealth, and you're seeing that particularly in the UK. Secondly, they are influencing decision-making within relationships far more than their parents' generation. Thirdly, they outlive men. And fourthly, they divorce men in some scale in London. So there's 4 really big clues as to why this is not political correctness. And this is why women are controlling wealth increasingly. So we at Rathbones are increasingly focusing on that. And just to give you an example of an event we ran, we worked with Ascension Ventures last week to host an event on female entrepreneurship with 5 amazing women talking about how they built their business. And then a panel discussion about how tough it is to raise capital for women. And one of the stats that came out is that no more than 4% of VC money goes to female founders. And indeed, we had another event where Dame Steve Shirley, and she called herself Steve, a remarkable woman who came over in the Second World War as part of the 10,000 Jewish children who were saved, and then set up her own software company. She called herself Steve because no one would take her call as a woman. So therefore, she changed from Stephanie to Steve. Now, obviously, things have moved on since then. But for us as a brand, it's incredibly important and not political correctness for us to see this major demographic shift as a huge opportunity.
Okay. Now, another big opportunity that was raised, in terms of are we ready earlier today was the role of ethical investing and, ESG, SRI, impact investing, all of this is becoming more mainstream, I think, as an asset class. We heard some pretty big numbers. What's Rathbones doing on the ethical investment side?
Well, firstly, at the group level, I think a different question is being asked of Rathbones. We're 270 years old. We run 47 billion of assets. We're quoted on the London Stock Exchange. And I would say 10 years ago, our institutional investors and stakeholders were asking us the question, how profitable are you? What's your net margin? How are you going to control costs? How are you going to keep growing? Those questions are still there, but something has changed. Our stakeholders are now asking, what about responsible capitalism? Can you grow with purpose? What is your impact as an organization? And we have a new chief executive who just joined 2 weeks ago, and he has asked us to spend some time on defining what we stand for, because unless you do that, you can't actually appeal to your stakeholders. And indeed, we're finding potential employees are spending a lot of time on this subject before deciding whether to work with us. So there has real benefit to our business to actually position ourselves correctly. Secondly, our clients are saying increasingly they want their portfolios managed ethically. We have a unit called Green Bank, which, unlike it being a fashionable thing to do, it was set up in '97 when just about no one was doing this. And we run in total 1.3 billion in that unit and another 1.3 billion in a fund where clients can tailor their portfolios to reflect their values. And again, this is not fashion, it's not political correctness. We're seeing a big uptick in that. And we had a conference last week for our Green Bank clients where, again, there was no sales content. We were talking about the closed loop economy where instead of taking things out of the ground, using them and disposing them, how do we actually reuse things and actually recycle? And if anyone thinks this is not going to be a major issue, you've just got to look at other industries. You're all going to be thinking about whether you buy an electric car next. You're all going to be thinking about when you go to M&S single-use plastics. And you're all going to be thinking about the clothes you wear, about whether or not you can keep them longer and longer rather than recycling and having beads go into the ocean. So I don't want to turn into an extinction advocate. I'm just saying this is really, really important, and it will drive business decisions by our clients and our shareholders.
So our last question then, as we tie this together, I mean, how, part of today, the question was asked is how ready are people in terms of wealth management being prepared for the next 10 years? So really a question I'd like to ask you, I mean, what's your view? How do the established wealth managers stay relevant and stay in business? What's your view on this? Yeah.
Well, that's an interesting question because, of course, we're not quite as old as Hawes Bank. We're only 270 years old. But in a weird sort of way, we are a business of great age, which is essentially a startup, because we have to actually face the new environment and behave like that.
Yep.
And in the last 5 years, we've grown from 20 billion to 47 billion, which is quite a growth rate. So clearly we're doing something right. But I think the way that we stay relevant is this. Instead of telling your clients what you do, because everybody says they're a brilliant investment manager, forget that. Tell them what your values are. And that means creating communities around you that have similar values. Our ethical investment clients, our diversity clients, the tech innovators who are going to be creating genuine wealth. And if you create those communities around a brand like us, it allows us to actually create stickiness to the brand and stay relevant. What we have to avoid is our equivalent of the Kodak moment. If you remember, Kodak discovered the digital camera, didn't understand the effect on itself, didn't invest in it, and thought it could keep just making film. The rest is history. We don't want to be in that position, so we have to actually surround ourselves with the new innovators that are going to be driving wealth. Otherwise, what's going to happen is that we will get stuck in a client community that is aging, and we won't be connecting to the next generation. I think that's true not just of Rathbones, but I think it's true of everyone in this room who provides financial services, that we have to stay connected to those people.
Ian, thank you very much indeed for those comments. Stay with me on the platform. I'm going to ask two others to come up and join me. So can I ask Maximilian Biesenbach from Simon Kucher to come and join us on the stage? Perhaps come and join me here. And can I also tell you that Mo Chukir from Kleinwatt Hambros unfortunately has had to go back to the office. But I'm very pleased to say we have a more than able alternative in the sense that Sean West, who you heard earlier on, the CEO of Eurasia Group, will come and join us on the platform. So Sean, can you come and join us as well? And I think there were a number of questions that we didn't have time for earlier on to ask Sean. But I would remind you that I'll ask questions. I have a few prepared questions, but really, if you ask questions from using the Slido, I'm more than happy to ask those to the panel. Okay, so let's just start with a first question. MiFID II, MiFID II, the client information letters have just gone out. Now these detail the charging for advice and tell you the product relationships. They tell you a bit about performance. I mean, I was going to ask is what has been the reaction from clients, in terms of are you worth it, when you see these letters? So Ian, can I ask you first of all, what's been the reaction in terms of Rathbone client base to the client information letters that have gone out with the transparent pricing?
Well, I think generally, actually, clients like more transparency. They like the fact that now we have to really reveal total expense ratios. We have to ensure that there are annual client reviews, that the risk profile is in keeping with the actual portfolio that you've got. I think one thing which has alarmed them a little bit is the 10% letters when your portfolio's gone down 10%, because the letter just tends to say, dear client, you're down 10%, buy. And then, unless you're careful, there isn't then a subsequent conversation with the investment manager ringing them up and explaining a little bit of content, because particularly by the time the letters arrive, they could be back to flat. So those letters have caused a little bit of alarm amongst the shires, if I put it that way.
Yes. Okay, thank you for that. So Maximilian, I mean, obviously we heard your presentation about pricing, and I was quite interested in the way that the Swiss banks were coming up with a standard an interim and a premium level of service. And the idea would be that the client can choose the level of service and pay the appropriate pricing for it. Yes. I mean, can you give the audience some perspectives on has that been successful, or is it maybe a little bit too early to tell? I mean, has that made a big benefit to the Swiss private banks?
Oh, it has. So
yeah.
without disclosing any particular client names or so. Yep. With those banks that we have supported, they have been able, for example, moving the former execution-only or self-directed landscape into advice solutions. It has had a tremendous impact on their book, so they were able to increase the gross margins by 8 basis points, for example. So if you do the calculations, that's quite a bit of money that's left on the table if you don't offer a differentiated value proposition. So I think it's been quite successful.
And presumably those 8 basis points are a higher quality of revenue, because presumably it's advisory mandate business, so it's more sticky business. Is it?
Yeah. So it's a contracted business.
Okay.
It's put under a mandate umbrella. Yeah.
Fine. Sean, one of the questions on here is, there's 2 questions actually. So maybe I'll give you. Both of them, and then you can reply depending on the balance you wish to put. So in the UK, why do you see a second referendum as a more likely outcome than a hard Brexit? And what question do you think the referendum would ask? So if I start with that one, and then the other one is, what's your view of Asia, and particular India, where the incumbent banks have a big majority? So I guess that's one of the members in the audience with an international.
Really simple questions.
Yeah?
Sure, yeah.
So I mean, I think I'll give you the choice of being brief on either of them, depending on your.
I'll be brief on both of them.
Thank you.
I think with respect to the Brexit question, it's prompted from a comment I made in the keynote this morning. So Boris is advancing as prime minister, right? We've seen that today. My view is he's a political opportunist. He was for Remain before he was for exit. Now he's hard Brexit, but sending mixed signals, right? The reality is, when it comes down to it, his goal is to get a deal, and his first goal is to maintain being prime minister. And so hard Brexit potentially forces a collapse of the government if he were to go down that route, and instead pursuing a referendum in that situation where he doesn't get the deal. The most likely scenario is that we see him create space with the EU to get a deal. That's the most likely scenario. I think he prefers a referendum to crashing out, because crashing out could topple the government, where a referendum could potentially buy him a sure year to try and fix the question. Right, what the question would be, that's an open question, right? With respect to India and Asia, we're reasonably positive on Asia. Obviously, I spent a lot of time this morning on the troubles that China's having with the US and a potential fragmentation there. India is a positive story, but not as positive as one might think, right? Everyone in the markets loves the concept of Modi and loves what Modi did in the beginning of his first term, and now he's won a big majority in the lower house, doesn't control the upper house. I think what we're gonna see is the fact that he won this mandate on the back of development, and that he's going to be much more focused on rural development and infrastructure than he is on further reforms. So, I would be a little more constrained in my optimism. It's a mild optimism with respect to India. In our official ratings, we're neutral on India politically in the next 6 months, positive in the longer run, as we see the effect from the infrastructure.
Thank you. So next question, Ian, this is one for you. What kind of engagement do you get at the events that you mentioned that you run?
It's a very good question. My chief executive keeps saying to me, this is just beautiful, Ian. It's just absolutely beautiful. But where's the money?
Where's the money?
Where's the money? Show me the money. And what I point out to him is that creating these communities actually takes 5 years, because if you're going to create that stickiness around your brand and really get people interested in you as a promoter and as a gateway of these issues, it takes time. But the short range answer to that is that we are actually getting potential clients coming to us saying, we think you reflect the values that we hold, and we'd like to come and become a client. And so I think there are results, but we have to have at least a 5-year view in it, and that's tricky for us because we're quoted on the London Stock Exchange, so we have quarterly reporting, which creates this kind of short-term mentality about results. But I think my CEO is pretty committed to actually taking that 5-year view.
Okay, thank you. So Maximilian, one for you on pricing. So, we've heard today, and this may be a UK-specific thing, but we've heard today, the clients lack education around financial services. I guess there's also, so the question I really want to ask is how easy was it for the clients to understand the pricing changes, and maybe also extend that a little bit to the advisors, because I guess, the advisors may have been used to selling the execution only at one price, and then you have a 3-tier level of pricing that you introduce. So I presume there's education with the advisors, and I presume there's education of the client base. So could you give us a sort of view on how your experience of how that has played out in Switzerland?
Yeah, so I mean, at least what I can say is that in order to make sure that the rubber hits the road, or that client advisors are able to sell your products and prices correctly, they need to understand them, right? So for example, there's 2 ways of making sure you have differentiated fees. The one is a stepped fee calculation, the other is a cumulative calculation, so to say. And wherever we introduced a cumulative scale, client advisors didn't get it. Most of the clients didn't get it either, so it was quite tough. So eventually we ended up going back to the old step tariff game, for example. So in short, if your bankers do not understand the pricing, then most likely the clients won't either.
Okay, thank you. Sean, there's another one that's come up for you. What's the biggest risk for wealth management going forward? Is it Corbyn, or is it a no-deal Brexit?
Yeah, it's a tough call. I think a sequence of a no-deal Brexit that leads to a collapse of the government that leads to Corbyn is probably the worst situation. But if we're thinking in the very short term, right, Corbyn would be a bigger shock to the markets, an unpriced shock. So you'd see an overreaction. I think a no-deal Brexit longer term is worse for this economy. That's my perspective. You will have constraints on Corbyn in a legislative environment, and the ability for the government to collapse if he pursues anything that's more than one standard deviation away from the norm on some level on policy, where a hard Brexit will be an economic shock that hasn't been fully digested, that will be durable, that we won't come back from. So I would take that one.
Okay, thank you. There's another one that's come up there. What's the future of ESG investing in wealth management? Obviously, there's been massive growth. We heard, I think it was 100% a year. We've heard that it's moving towards being a mainstream asset class. I mean, what's the future? Probably one for you, Ian. I mean, what's the future of ESG investing in wealth management?
Well, if you look at our business, which is 47 billion, and we only have 2.6 billion of our assets in that 4.47 billion in this space, I think the potential is large, because it was previously a deeply committed group, but what we're seeing now is that nearly all clients are saying, can I have an element of my portfolio? And then the next question they ask is, can I actually still make as much return from an ethical portfolio as one that isn't?
Yes.
And our answer to that question is yes, because if you invest in well-governed companies, you tend to get better return on investment than investing in companies that take their responsibilities lightly. So we could see over the next 5 years, certainly in a Rathbone context, at least a doubling of that kind of issue. Right now in the UK, probably only about 7 or 8% of pension money is invested ethically, and we could see that growing to at least, I think, 14, 15%.
Right.
It's a guess,
yes.
But certainly from the trajectory we're seeing, it could increase significantly.
Okay, thank you for that.
Sorry, did you have a...
Yeah, maybe
Yeah.
to add to that,
Yeah.
also what we see from a pricing or margin perspective, these environmentally friendly solutions also trigger additional willingness to pay. So when we look at enforced margins of, let's say, a normal or model portfolio that is invested across all industries, and then there's one without tobacco and weapons, for example, these typically, if they are bought on purpose, yield up to between 3 to 5 basis points higher margins than the non-ESG portfolios. So it's also, from an economic standpoint, it also makes sense.
Okay, thank you. So Sean, what's your view on the trade wars between the USA and the rest of the world, especially China and India?
I think it's pretty nasty stuff.
Yeah.
My bet is if we were sitting here in 12 months, we're going to have had a negotiated resolution to the U.S.-China trade war that will have cost both the U.S. and China billions of dollars for having played this game, but we'll be much more concerned about the technology tension between the two countries and the geopolitical tension between them in the South China Sea than we will about trade. With respect to India, I mean, Trump is basically, one day he's fighting a trade war with India. He welcomed Modi into re-election with a trade war. He's done the same thing with Mexico. He's threatened to do it with Europe and suspended it. I'm less concerned about that. The real issue is on trade is between the U.S. and China, because the balance of trade is imbalanced. It's not imbalanced, and Trump has the view that he can bully them into balancing it, which I think is misplaced, where that's not really the case in all the other contexts.
Thank you. So here's one for all of you, a nice one, I think. Where would you invest your money now over the next 3 years? So you're looking for a 3-year return. Where would you invest your money? Shall I start with you, Max?
That's a good question.
Where are you invested, or where aren't you invested?
So I needed to invest into the company, so I don't.
Okay.
The question is.
So private capital.
Is
we could say,
soft for
we
me
could say
right now,
private
yeah.
capital, couldn't we? Ian, where would you?
Well,
would
if
you
I
mind?
had a compliance officer here from Rathbones, he'd be having 50 kittens about me doing, and Laura's here from my firm, and so you please, Laura, report that thank you.
Personally,
like this.
personal investment.
I'm going to say this personally, as opposed to
Yes,
Rathbones.
yes, personal investment.
Please read the disclaimer. For me, one of the really interesting sectors which has actually had the least investment is the agricultural sector, a $1.4 trillion industry, which has had the least application of technology of any of the sectors. And there are some very exciting developments around cellular meat technology, vertical agriculture based in cities using hydroponics, artificial light, etc. And the whole ability to, for example, get cattle off the fields, and actually reduce the methane and CO2 footprints, I think is a very interesting area. The only problem with it is it's kind of difficult to invest in the public area. There is one company that has floated recently in the cellular meat technology, but I can see that growing as an issue. But that is a personal view.
Yes.
And we tend to think about this in a country context. I mean, I think Trump is more likely than not to be reelected, and actually that's been pretty good on a domestic point of view, right? He's an exporter of risk, but the domestic situation has actually been reasonably business supportive. So, I would be mildly positive on the U.S. Looking abroad, both Brazil and Vietnam as country stories seem to me to be better than the markets appreciate, and would be places that I'd be looking for positives.
Right, so we're coming to sort of the close of this discussion. So, I mean, maybe the question I should ask is, let's roll forward to 2022. Imagine we were sitting in the room in 2022. What would a successful wealth manager of the future look like? What does success look like in 2022, which is not that far away? We've heard a lot of discussions. The question Mo posed at the very beginning of the conference is, are you ready? And so this is, what do we need to be ready for, and what will it look like in 2022? Ian, can I start with you?
Yes, I think the successful organization in 2022 is one that marries much improved technology with human skills. And what I reflect on in a lot of these conferences is that we're mirror images of each other. The incumbents have scale, profitability, and content, but generally speaking have weak technological applications. The new tech robo-advisors have got great apps which are easy to use, very easy to understand, but they tend to lack scale, profitability, and content. So I don't see those two as necessarily competitive. I can see those two merging together. And in the same way as technology has shifted incumbents, you've just got to look at what Airbnb has done to hotels, what Uber has done to the transport sector. I can see tech companies in this room working with incumbents to actually improve the offering. So don't view it as competitive, view it as collaborative. And by 2022, I'd like to see Rathbones applying its human skills in a much more systematic and efficient way using technology.
Okay, thank you. Maximilian, what's your view of what does success look like in 2022 for you for a wealth manager?
I think it would be that the industry caters to the different clients' needs, usage patterns, and requirements with a differentiated value proposition and pricing landscape. That would be my idea view.
Okay. Sean, what about you? Have you any views on?
So I wish you asked 2032, because it would be the AI of your wealth management talking to the AI of all your rich clients who invested in AI, potentially. But from a 3-year perspective, I think it's all about the human experience. It's about firms that are able to bring insights and educational opportunities and experiences to their clients, not just the core product that will end up being the differentiator.
Right. We've still got a little bit of time, so so maybe this one. Who's this one? Oh yeah. So people don't identify with generational labels. I mean, Ian hinted at this when he said people identify more with values, and we heard about the need for values. You know, in terms of business value, but also social value.
Yep.
So how can banks genuinely demonstrate these values? I mean, I think, Ian, you alluded to some companies that are in the forefront. Maybe you can...
Yeah, I mean, maybe I could talk to a competitor and say how impressed I've been by Bank and its personal service to its client base. It never tries to be the cheapest, but it tries to be the best in its space. And its 350-year history shows its resilience. We are only 270 years old, but we actually think that the values of direct exposure and involvement with our investment managers, not differentiated by broken by a relationship manager where you've got your own investment manager, and where we talk to diversity, where we talk to the new tech innovators, and where we talk to the fact that we vote our money, our 47 billion at AGMs. When we see things that we don't like, our stewardship committee will actually vote against excessive corporate pay, and it will address the issue of child slavery in the supply chain. We need to be activist in that area. Yeah. So the way that firms like us will demonstrate our values is less talking and just action. Okay,
thank you. Maximilian, do you have a view on that? I mean, the values. I mean, people don't identify with generational labels. Is that true in your experience in pricing as well, or is there more of a generational pattern to the pricing, or is it less so?
To be blunt, I don't think I have anything smart to say on that.
Fine, all right.
But you can talk about value for money.
Yeah, value for money. Yeah, value for money. Yeah.
Certainly could.
Okay, all right. So. Sean, will the next generation of clients associate more with apps and algorithms than investment processes and committees? That's an interesting one. So will the next generation of clients associate more with the technology rather than the investment process and the committees? Maybe, again, Ian, if you lead on this one.
Sorry, me?
Yeah.
Yeah, I mean, one of the things that worries me a little bit about the tech revolution is a lot of the platforms are investing 100% in ETFs because, generally speaking, they don't have a research base to them. Now, we saw what happened even in Q4 of last year when the market slid heavily, and it was led a lot by algorithmically based ETFs. And that worries me a little bit because actually one of the advantages of old school investment processes and committees that you fundamentally understand what you're investing in and you don't put everything into that one area. So I personally believe, again, this marriage between technology and human beings, it's fine to have ETFs in your value proposition, but don't sell just one form of investing. And I think the human process of deciding where every month the market is, as you were saying, Sean, I think that has got a real value to it. Otherwise, it's just incredibly passive.
Okay, does anybody want to make a comment on that, or I draw the session to a close? No? Okay, so I think it falls on me to summarise. Being the last chairperson is always the worst role because they ask you to summarise the day's events. So I would go for 4 themes from today, and people from the audience, you're very welcome to correct me on the Slido machine if you disagree. I think the first big theme in terms of are we ready is the first big theme is wealth in motion. This has been a topic, whether it be women, whether it be multi-generational transfer, whether it be wealth in businesses that float in the market. But there's going to be quite a lot of wealth in motion for the wealth managers. I think this is a good thing. Now, not everybody is probably geared up or ready for all of that wealth in motion, but at least it's there. So I think that's my first conclusion from today. The second is I think we start to need to think about business slightly differently, and this is Ian's point, and I would call this the growing importance of societal trends. Many of you in the UK will have seen those programs with the pile of plastics and the plastics in the ocean and all of that sort of stuff. So I think we're moving into a new era, which is slightly different. So I would characterize that as societal trends, but maybe it's business and social value. And it will be increasingly important for wealth managers to be ready to demonstrate both business performance, but also social value, as Ian was saying, and he gave us some examples from Rathbones. But I think that's a pretty consistent theme. So that's my second theme. I think the third theme is what I would call is there's money on the table which we might want to think about. And that really plays to the presentation that Maximilian gave and his very interesting comments just a few minutes back that the Swiss private banks have managed to raise the basis points by 8 basis points. That's quite an interesting concept. And they've done that by differentiating the offer and differentiated pricing. So, we're moving into an era of personalization. I think the technology is only just beginning to get to adjust this. I think we're coming to an era of hyper-personalization in a few years' time. And, Sean was talking about AI. I mean, the potentials from AI are enormous down the road. So I think that would be my third area. And then fourthly, I think it is we've had some very interesting discussion about the role of the hybrid advisor, and I think that also offers enormous potential. And I can't help thinking about the comment that was made by the speaker from Coutts. He was talking about the chassis, and there were many options to create a hybrid advisor model. So I think, again, we've only just scratched the surface. In terms of answering Mo's question, I think I'm going to leave that one to you. Are we ready? I think one half of me says yes, I've heard a lot of positive things from today's discussion, but another half of me says, well, the action is in the doing. And somebody mentioned also that the wealth managers haven't been the greatest users of information technology, which is music, of course, to my ears. But so the question, I think, are we ready? I'll leave that one to you to decide. I think I must end now. I'm going to ask the editor of Private Banking to come up in a minute, but could you just put your hands together and thank our panel?